The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
You have probably had somebody tell you over some event, this time is different.
You hear that a lot. Yeah.
and people want to say, well, I don't know if it is or isn't because it's always worked this way in the past. They said, no, this time is different. And when it comes to the stock market, it's always different this time around. There are so many
really
variables.
Good way to look at it.
There are so many variables that go into investor decisions. There's no way that they can repeat. We look at charts, and so chart patterns show up, but they're not always on the same chart. They're on a different stock or a different mutual fund or a different exchange traded fund. And you try to find that same pattern on the same chart, that becomes really difficult. So patterns repeat, but when it comes to the stock market data, just accept this time is different. And the way you used to make decisions for most people is a reaction to things that are going on. It's not a process, not a disciplined process of evaluating what you're looking at. And that is what we do for our clients. We have a process, a designated universe of assets that will go into the portfolio. You want to know that they have adequate liquidity, that you're not paying too much, that the spread costs aren't abnormal, that if you decide you want to sell, there's plenty of people who are willing to buy whatever you want to get rid of. I mean, just because it's on the stock market doesn't mean it's a good investment for your portfolio.
Isn't that the truth? Isn't that the truth? And I think it's really important to remember here that there are plenty of people out there all the time telling you why stocks move. Well, this, and this happened, and this is why this stock took off. Those are always after the fact. Those are always after it's happened. It's never just before it moves, or it's never while it's taking off, never in time to do anything about it. But after the fact, they want you to know that, oh, they were very smart and they knew exactly what was going on. Well, they didn't. They had no idea, but they're going to tell you, we know why this happened. And the next time it happens, we're going to see it, and it's going to happen again. And so, pay for our service and we'll keep you in front of this curve all the time. Doesn't work that way. It's always looking in the rearview mirror where they find the big narrative of why something occurred, and seeing it again, like you just said, Don, is virtually impossible. The history does not repeat itself in the stock market.
Well, nobody knows the future. So that the only way
Correct.
you can explain something is in retrospect. We take a look at what's happened with the Magnificent Seven.
Yep.
People were touting the Magnificent Seven the better part of last year. Nobody was touting the Fabulous Four, which are the survivors this year. But you didn't see in the headlines, well, you need to get rid of Tesla, for instance. Well, Tesla's, it's having a really tough year. You have massive increased competition, prices being cut by Chinese manufacturers, difficulties with production, and the Tesla stock's down 33%. Last year, it was one of the Magnificent Seven, and now it's not. It's no longer even part of the Fab Four. So things change.
You couldn't own enough. Yeah, you couldn't own enough Tesla last year. You couldn't get enough in your portfolio. And now you're asking yourself, why do I own any of it still? And that is how fast things change. But again, like you said, Don, last year, there was nobody saying, you know what you should do? You should sell Tesla as fast as you can. That's going to turn into a real dog next year. Nope. I didn't hear that from anybody. Or how about betting against Apple? Well, we think Apple's going to collapse. Really? Funny. I don't remember hearing that, but it's had a very tough year so far.
Well, the other contrarian that was not hitting the news was energy. I mean, but what do we have? We have the Ukraine war. We have the Mideast Gaza conflict, and we have the Houthis trying to sink ships in the Red Sea. Those are geopolitical events. And we have China's economy struggling to stay afloat, which is a lack of demand. We've had some shortages that show up and supply disruption, which has made energy a better return so far this year than technology. If you go back into the 70s, one of the major sectors in the S&P 500, the top sector, matter of fact, was energy.
Yep.
And
That was it.
now it's about 2% of the S&P 500, less two and a fraction. And Exxon is a leading company again. And so in December, you'd have to say, who'd have thunk it? It's just
Exactly.
this time is different. And now, what are you going to do about that? You're going to hang on to your Apple and your Tesla stock, or you're going to rotate into energy, which is gathering momentum. It's becoming a magnet for investor capital. It's leadership. What do you do with
And you
leadership
can
if you don't own it?
you need to own it, and you need to understand a little bit. In this case, why? Why is energy all of a sudden popping up like that? And again, it's coming back to the Fab Four. It's technology, and this massive expansion of artificial intelligence is causing this huge surge in the need for data storage, and that takes a ton of energy, way more than anybody ever considered in the past. And now it's enough that it's driving energy companies into the top of the market because they're in such demand. And nothing trumps supply and demand. When you're in demand, that's when you attract that money. And that's what's going on with energy stocks right now, because they need so much, specifically electricity, to run all of those data farms to keep AI running.
Yeah, so through last week, year to date through last week, NVIDIA is still the number one earnings generator. I mean, massive growth because of the
Yep.
AI, and they control the fastest chips. And then you have Meta platforms. Meta has a lot of data that is needed for making AI work. How do you train
Correct.
it? And Meta probably has the largest database available for training AI. Then you have Amazon. Well, they have the data about how the economy is working. And then you have Exxon. It's the fourth best returning company this year.
How about
That's
that?
what I just said a moment ago. That's in the who'da thunk it category. Mortimer Snerd from the 20s or the 30s, the little puppet, the snarky little guy.
Right.
Anyway, what's the issue in terms of portfolio management? Most portfolio management is, let's take a look over our shoulder the last 80 years and say, well, on average, this works. So we'll own a little bit of that, and we'll own a little bit of this, and this one doesn't work that well, so we'll own less of it, but we're going to own everything. That's not what smart money managers do. That's not what hedge funds do, and that's not what we do.
Right.
We use momentum. Momentum identifies where stocks have become magnet for investor capital, magnet for money. It's a short way to say that.
Yep.
Momentum goes through cycles, and when there is a strong shift in leadership, momentum changes. We go through hard times, and price movement doesn't persist. I use the illustration of learning how to drive a stick shift. When you first start learning a stick shift, how to operate the clutch, it's a pretty jerky start. And when there's no clear leadership, that's what the market's like. It's just like, well, that clutch doesn't work. Well, I'll try a different car with a clutch in it. Well, that one's not working either. Well, I'll try a different car. The problem is the driver trying to operate the clutch. It's not that the clutch doesn't work. It's just that the environment in which, in this case, the market is trying to struggle with where is the economy going and what is actually going to be the magnet for investor capital. When that gets sorted out, you end up with momentum, and momentum can last for an extended period of time. With AI, the market hasn't figured out yet the total ramifications of what AI brings to the table. And Perry, before we started recording this, you were telling the story about the movie producer, TV show producer.
Right.
and the new text to graphics AI program, which you ran
Yep.
across, and I read the article on. Let's talk about this. This
Yeah.
is a massive
Tyler
change.
Perry. Yep. Tyler Perry he's already a hugely successful television show and movie producer, and he was doing $800 million expansion of his production company. And when he saw the newest generation of AI that could generate both still pictures and video just from a simple prompt, just a really simple prompt and really high quality stuff it was turning out, he had to freeze it up. He put a hold on it immediately, even though it was, pushing $1 billion expansion. He shut it down right away, saying, it would take us months to produce this kind of stuff, and they can do it with a prompt now. So that's going to change very much what we need to be doing, and it's going to change immediately what I need to be spending money on in a huge expansion. So that's disrupting technology. That's technology coming in and changing the way a business works, and having somebody recognize it right away and saying, "Whoa, whoa, whoa, wait a minute. We used to spend all kinds of time producing this, and now that has become a commodity. We still need the idea. We still need to be able to know what we want, but getting it there is now become a commodity. We don't need to pay a lot of people a lot of money to produce that, write all that code, produce all those graphics. AI is going to crank that stuff out in an instant." And so it changed it very, very quickly. And that's how fast AI is changing things. That's one of the reasons that the investment community is kind of on their heels, wondering what's next with AI. That's how Exxon ends up in the Fab Four. Nobody really thought about that. And then it was like, oh yeah, AI needs all that data. They need all those data farms. They all run on electricity. Somebody's got to produce all that power. And while they want green energy, they don't have it yet. It's just not there. So oil and gas are going to provide the electricity to drive that for the foreseeable future, and they're getting paid for it. So it changes things very quickly. That's why, like you said, Don, that managing your portfolio looking backwards, it never did work. Now it really puts you in a bad position to miss big moves that are going on that are very plain to see. You just have to be willing to watch them and be nimble enough to take action.
Well, one of the changes that has occurred recently is gold. We were on the
Yes.
radio back in 2011. So before we doing podcasts, we were on the radio for 14 years at various stations in the Seattle area. And in June of 2011,
Yeah.
we made the announcement that gold and, by the way, emerging markets at the same time had reached a peak. And if they were in your portfolio, it was time to get rid of them. It's just this year that gold has finally returned to its June of 2011 peak and finally moved higher. Well, that's a significant change. If you're not paying attention, you went through 11, 12 years of no return on your money for having held on to your gold. And now finally it has. So this is a change. It's different this time, but you also mentioned that things that we used to do and expect to be our normal business activity are turning into commodities because of AI.
Yep.
If we go back
Right.
into the 70s, commodities were a major sector for generating returns in your portfolio, in large part
Absolutely.
driven by OPEC and our economic expansion and OPEC controlled oil supply. And they cut off production, they shut it down, and it created a big spike in prices. Well, the U.S. has become the major supplier of energy, of oil exports and natural gas
Correct.
exports, liquefied natural gas. We're the dominant player. In fact, oil prices would be lower if the administration would allow pumping, exploration, and exporting. But they've just withdrawn permits and won't let it happen. So the administration actually wants higher oil prices and higher inflation. That's their policy. They don't say that, but that's the impact of their policy. This is different this time around than the last time around. So what do you do with your portfolio? Have you made adjustments accordingly? I mean, you have energy and other commodities. Copper is going up. Look at the demand that's coming from, electric vehicle demand is softening, but the energy demand that the data centers need to process AI has to come from somewhere, and we do not have even transmission capability. These data centers are being built as close as they can get a permit to a power generating source to minimize the amount of transmission that has to be put in place to make them operational. And green energy, as theoretically attractive as it may be, does not have the capacity to support a major data center. They
Correct.
all have some sort of backup or primary system that is fossil fuel generated because it is on 24/7 and it is reliable. And if you're close enough to the generation source, I mean, you know you're going to have power. And if you have to put in your own transmission lines, it's less of a project than trying to build it halfway across the country.
And probably necessary. Yeah, you're going to have to do that because you do need that power, and you need it uninterrupted for any reason. And all of a sudden, energy's on the map again. How about that?
So when it comes to momentum, it's important to understand that momentum, like everything else, will change. Most people who criticize momentum do so because they are long-term investors and they don't have stop loss provision. They don't have a stop loss plan in place. Maybe it's not an official entry into your account at your broker's firm, but you at least are watching the charts. You're watching what's happening with your positions, and you know that there's only so much drawdown that you're willing to tolerate, in which case you don't argue with yourself. You have rules, and you follow your rules, and you exit. And maybe it doesn't collapse, but in many cases it does. You think of 2008 and 9 with the housing bubble. That decline started in the summer of 07, and it didn't end until the March of 09. You think of the technology bubble that peaked in March of 2000. They kind of floated around for a year, and then it collapsed into March of 03. It's a multi-year collapse. So that's downward momentum. You don't want to do that. You want momentum when it's a magnet for money, when investors want to put more money into it. But it will come to an end. All things in the market come to an end. And we probably should too at this point in time.
Correct.
I saw you looking at the clock. We run portfolios on the assumption that whatever we have is going to change because that's the way the market is. You want more information about how we would view assets in your portfolio, give us a call or send us an email. It would be a free review just to examine your risk exposure and the way you're weighted for leadership or laggards in the market. It makes a huge difference in your potential return. Subscribe to our podcast. Sign up for our website or for our stock market reviews. They're on our website. Have a great day.